US Treasuries aren't the only bond market that's rapidly unwinding in the face of a growing deflationary shock. China's epic bond rally marches on, reaching new lows of its own, as incoming data on the Chinese economy only confirms the bond signal, including a sharp drop in prices during the month of August. That's bad news for the whole world, and not in the future either, right now, and it's playing out all over the place. Bonds in the world's two largest economies are signaling deepening trouble, so of course Copper's going to be weak, gold is going to be high, and that means another low in the copper to gold ratio. Now that's a very bad sign since we haven't seen this low but a few of the worst cases of the past 30 plus years. And other key commodities are being crushed too. Steel, iron, even Chinese stocks that look like they were set to soar into recovery, they're only a few points away from their February multi-year lows too. Whatever small reflation hope there may have been a few months ago, it's been devastated by spreading, not retreating weakness. Turns out bonds, globally synchronized bonds, they were right about the worsening state of China's and the global economy, therefore the failure of government stimulus over there. But Chinese bonds like US Treasuries aren't just pricing where the world is today, they're looking ahead into tomorrow and next year. And that's where we really need to be concerned, especially as all these past signals are being confirmed by real world data and these market prices. Even the mainstream media, yes, the mainstream media, as much as it doesn't want to, it can't deny this any longer. At least as far as China's part in the globally synchronized economy, some truth is finally starting to leak out. Here's a headline from Bloomberg earlier today. It said, China's deflationary spiral is now entering dangerous new stage, which is nothing new. We've been talking about this all along. That's where bonds have been pricing. That's why the PBOC has been so incredibly insistent on interrupting and derailing the bond rally. Here's what Bloomberg wrote. Deflation stalking China since last year is now showing signs of spiraling, threatening to worsen the outlook for the world's second largest economy and raising calls for immediate policy action. A broader measure of economy-wide prices, known as the gross domestic product deflator, will likely extend its current 5-quarter drop into 2025, at least according to Bloomberg Economics and analysts at banks including BNP Paribas. That would amount to China's longest streak of deflation since data began in 1993. And that's on top of producer prices, which we'll get into a little bit later. We are definitely in deflation and probably going through the second stage of deflation, said Robin Xing, chief China economist at Morgan Stanley, citing evidence from wage decreases. Experience from Japan suggests that the longer deflation drags on, the more stimulus China will eventually need to break that debt deflation challenge. And what are these people talking about? More stimulus? How much more stimulus does the Chinese economy need? How much more stimulus programs need to fail before mainstream economists give up on thinking the government is going to fix every single problem? It's either the Fed or a central bank or some kind of spending program that fixes the situation. When markets are saying, especially China's bond market, US Treasury market, there is no fixing the situation. The Chinese government doesn't have some kind of magic beans that it can sell to anybody other than the financial media and just create a magic happy recovery. This isn't about stimulus. This is about the big problems that go way beyond just China's real estate bubble. We're talking about silent depression stuff here. And it's getting worse. It's coming back. And most of all, what we're seeing is that the last couple of years, the pandemic, the overreactions, everything that happened since 2020, we are going to have to pay for it. And that includes China, the United States, the entire globally synchronized world. That's what the markets are telling us, especially these bond markets, as rates go lower and lower. Flight to safety, liquidity in high demand, lower growth and inflation expectations with the emphasis on the growth part, lower growth expectations, China, the US, around the world. That bond rally in China just gets bigger and bigger and bigger, and it gets more and more impressive in all of the wrong ways. Now, the Chinese 10-year hit a record low early August as flight to safety was all over the entire global marketplace. Financial conditions were just liquidations and everything else that went on with the yen carry trade reversal. Remember, this is not about the yen or Japan. It's about global risk perceptions. That's what triggered it. And that includes, obviously, the Chinese as the world's second largest economy. So with China's 10-year government bond yield going down to 2.1% as of August 1st, that was consistent with everything else that was going on. But then remember what happened. The PBOC came in, even before August 1st. For the last couple of months, the Chinese central bank has been trying to cajole the market and to influence the market to sell off. They actually want rates to go higher because they know what the signal actually represents. It represents nothing good about China's economy. So the PBOC, remember, they threatened to short sell into the marketplace. They arranged to borrow hundreds of billions of Chinese government bonds from various brokers, threatening to sell those nakedly into the marketplace, which they've never done because it's actually a stupid tactic. But they were at least threatening to do something major to derail the bond rally. Remember, they also told rural banks in China to outright cancel bond trades that they had already made. They went through and had brokers listing fewer bonds voluntarily, quote unquote. State-owned banks were told to keep a list of habitual bond buyers. And then they actually contacted those habitual bond buyers and said, we don't like what you're doing. At least that's allegedly what they said. And these habitual bond buyers, I'm sure, voluntarily gave up their habit of buying bonds. But either way, these PBOC tactics worked in the short run. So we had a record low 10-year Treasury yield that backed up from 2.1% all the way to 2.2%. But at least the Chinese long-run bonds have been sideways since early August as compared to the front end of the Chinese government curve, which continues to sink lower and lower and lower. So at the very best, the PBOC's tactics have been able to buy sideways to actually slightly lower now in Chinese 10-year. But in the 5-year, the 5-year got down to about 1.8% around August 6th. And then like everything else, not just in China's government bond market, but around the entire world, everything hit that big low at the start of August, and then it backed off. But we see this time and again in all these marketplaces, including Chinese government bonds, August 15th. Remember, globally synchronized. We saw Japan's yen go lower after August 15th. Oil prices and gasoline in the U.S., mid-August change there as well. The 2-year in the U.S. Treasury, that one turned around August 15th as well in the short run. So the second half of August, we've got another globally synchronized wave building up, and we can see it very clearly in the front end of China's government bond curve. And as of before I started recording here, it's down to 1.756%. That's another low there. The 2-year got down to 1.5%, or just about 1.5%, way back at the end of July. Remember, swap spreads going lower too. This all globally synchronized. That stuck around 1.5% until again around August 6th, and then backed up like the rest of the Chinese bond curve with the PBOC threats, and not actually threats, actual action taken, as I talked about just a second ago. But the 2-year Treasury yield only got up to about 1.69%, and then from August 15th, it's been moving back lower. And as of earlier today, 1.42%, which is a new low. And in fact, it's only about 10 basis points above the April 2020 low. So China's government bond curve, these yields look more like 2020. But Chinese stocks, the Shanghai SSE, that has completely round-tripped the earlier year stimulus craze. Remember, Chinese stocks fell to a ridiculous low back in around January and February. And then, it was one announcement after another from the government. They're going to do this, they're going to do that, culminating in May with the release of the historic stimulus plan, the Chinese government's idea to finally fix the real estate problem, the historic rescue. And ever since they announced this historic rescue, it's been downhill ever since, even in China's stocks, which were ready to buy the stimulus story. They were ready to buy reflation, at least between February and May. Since then, it's been downhill. In fact, the Shanghai SSE, which got as low as 2,700 back in early February, rebounded by about 17% to 3,171 by the time in mid-May when they announced that historic rescue. And as of this morning, it's back to 2736 and just a little bit above that early year low. So even Chinese stocks are saying we're done with this whole mess. It's time to really focus on what's really happening in China. Forget all the stimulus. I wish economists would forget all the stimulus, but they can't. Instead, the risks in China are not just risks. Because of that, commodities are being crushed or continue to be crushed. Copper, like a lot of other commodities, including oil for a little bit there, it rebounded after the plunge early August, like everything else liquidated. Copper prices got down to around $3.92. This is in US dollar terms per pound at the CME. By the end of August, August 27th, copper was back up to 423. Not great, but at least better than 392. But since then, over just the last week or so, copper's been liquidated again down to just about $4.01 per pound. As of Friday, it's up a little bit, about a nickel here today. But with gold steady around $2,500 per ounce, that means as of Friday, as all of the stuff I talked about in last week's video were going wrong, all of the crash in commodities and oil and everything else, the unwinding on the US Treasury curve, the copper to gold ratio set another new cycle low as of Friday. And again, as I talked about in a recent video, it's keeping very horrible company here. We haven't seen the copper to gold ratio this low over the last 35 years outside of 2020, 2016, and December 2008 and February and March 2009. This is not the kind of company you want to keep for any critical measure, especially one like copper to gold. And everything continues to look like it's moving in that direction. We don't want to say it. We don't really want to think about it. But if we were moving in that type of downturn scenario, globally synchronized recession, deflation component, and everything else, as copper to gold is pricing, what would go differently here that we're not seeing right now? So you've got the correlation with Chinese treasuries, and I have to thank Eurodollar University member Mark for showing me this chart. It's an absolutely beautiful chart that shows the very solid and very tight correlation between the copper to gold ratio and China's 10-year government bond. And you know what that means? Transitive property here. That means China's 10-year government bond yield, which is very tightly correlated to copper to gold, which also means it's tightly correlated with US dollar swap spreads, and therefore every other Eurodollar signal. We've got tight cyclical signals globally synchronized, and that's the bad news because they're all looking increasingly ugly. Not just copper to gold or Chinese treasuries. We talked about all the rest, the bull steepening on the US Treasury curve. But the key here is globally synchronized in all these markets because it's not just the markets that are globally synchronized. Iron prices continue to sink down to around $91, $92. That's the lowest since November of 2022, back when China in particular was still in the worst stage of its lockdowns. That's where iron is today, comparing to the worst stages of China's lockdowns. Shanghai Steel, China's steel rebar futures, that had been around 3,400 CNY per ton as a low for the last several years coming out of the lockdowns and everything else. But then earlier in August, it had gotten down to 2,900 CNY, which was the lowest since 2016. An extreme low for steel, critical commodity in China. Then it rebounded a little bit like everything else. And then as of the last week or so, steel is rolled back over and heading lower. Last check, it's back down to 29.37 and almost back to that almost decade low. And we're already seeing the downstream consequences from not just China, but this globally synchronized deflationary shock that's building across commodities and everything else, especially in all of the commodity resource-rich economies around the world, including Australia. The Wall Street Journal reported last week Australia's commodity-rich economy recorded its weakest growth momentum since the early 1990s in the second quarter, as consumers and businesses continue to feel the impact of high interest rates, with little expectation of a reprieve from the Reserve Bank of Australia in the near term. It's not about interest rates. It's not about the Reserve Bank of Australia. It's about globally synchronized weakness. The economy grew 0.2% in the second quarter from the first, with annual growth running at 1%, the Australian Bureau of Statistics said last Wednesday. The results were in line with market expectations, as the market expectations look around the world like a lot of commodities and bonds and everything else. It's getting increasingly ugly. And remember, these markets are not looking just at today, but they're looking at today and what that means coming up. As far as macroeconomic data, the Chinese this weekend reported on consumer and producer prices, and consumer prices only look positive because of a sharp and painful spike in especially vegetable and pork prices. The overall CPI was up for the second straight month at 0.4%, month over month. That brought the year-over-year change to about 0.6%, which is basically the same range for the entire year. Food prices were up about 3.4% on the month because of an 18% surge in vegetable prices and a 7% surge just in August for pork prices. So two of the key food prices up big time last month. But that's it for as far as positive consumer prices. It's all weakness from there on out. Non-food prices actually fell 0.3% on the month. Even services prices fell by 0.1%, suggesting that China's consumers, who are already beleaguered, that's already weak, they might actually be getting worse, which is again what bond markets have been telling us all year. Producer prices, maybe the bigger concern here. In fact, it really is the bigger concern because that's the one that's really related and corresponding with global conditions. And producer prices actually turned positive, if you remember back in May when copper and aluminum and some of those supply squeeze commodities started to rise and actually surged on the supply squeeze. Well, that impacted producer as well as factory gate prices in China, but that's distant memory. Since then, as I just reviewed in the commodity section, everything's been going lower, including the goods that come out of Chinese factories to the rest of China and the rest of the world. According to the Chinese government, for August, producer prices tumbled by 0.7%. That's the biggest monthly drop since June of last year. And there were widespread negatives in every category. In fact, there are only, if you look at the page from the Chinese government, there are only a few zeros and maybe one or two positives out of a sea of minus signs all across producer and factory gate prices. Factory gate prices performed similarly to China's producer price index, down 0.6% on the month. So bond yields in China continue to go lower like they are here in US Treasuries and in Europe as well. And lower yields are not stimulus. They're a sign that things are going wrong and that more things are going wrong. Heightened demand for safety and liquidity, lower growth and inflation expectations. This is not about rate cuts, either the Feds or the Chinese, the PBOC. This is about the market saying, I don't like what's going on here, because in part, the data that continues to come in all around the world, especially China, confirms that deflationary impulse that's building and building and building in these globally synchronized markets. Commodity prices. Oil, I talked about over the weekend. Oil down big. Gasoline in the U.S. obviously down huge. But oil is down because the U.S. is weak and China gets weaker and weaker still. So we've got commodity prices, steel, we've got iron. We've got also big one, copper and gold. Copper to gold ratio hits a new low, moving further into the same territory as 2020 or 2008, 2009. Consistent with everything else that we're seeing here in the bond market and in the commodity markets and the global economy. This deflationary impulse that the bond market is picking up is increasingly not just about today, it's being confirmed today for what it says about tomorrow and next year. I talked about how important the copper to gold ratio is, and I went over the details behind it in the video linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.